Um, I'd like to welcome everyone to the virtual seminar on climate economics. My name is Fran Moore. I'm an associate professor at the University of California, Davis. I'd also like to acknowledge my seminar co-organizers, Mara Gwant from Northwestern, Glenn Rudebush from the Brookings Institution, and Lynn Barrage at ETH Zurich. Our speaker today is Ben Collier. Ben is an associate professor in the Department of Risk Actuarial Science and Legal Studies at Temple University, but in the process, very much in the process of transitioning to University of Wisconsin-Madison, where he'll start over the summer. Ben's work focuses at the intersection of climate risks, household finance, and U.S. disaster assistance. And today, Ben is going to talk about credit when you need it. There will be 50 minutes for the presentation, followed by 25 minutes for questions and discussion. To ask a question, type it into the Q&A and raise your hand. During the presentation, we will cover clarifying questions, but the bulk of the questions should come after the presentation. We are recording the seminar for posting online, but we will not record the Q&A session. So Ben, the floor is yours.
Great. Thank you, Fran and Glenn and Lynn MR for organizing this great series and for inviting me to participate in it. I've already benefited a lot from it as a consumer. So this is a paper, Credit When You Need It, and this is going to look at disaster lending and the need for emergency credit right after severe climate events, natural disasters. And this is joint work with Dan Hartley at the Chicago Fed, Ben Keys and Cian at Wharton. And I should note that we have the standard disclaimers for the Fed and others on this work. So this paper is motivated by recognition that households face a variety of types of shocks. Some of them can be large value shocks, so an employment spell lasting for several months, or pandemic, big medical expenses, and a severe climate risk is sort of the one we'll focus on. It sort of falls into this category of potentially large shocks that households face. Despite some of this exposure, many of these risks are uninsured or partially insured. And in this context, we might think households are going to manage this risk through liquidity, but households hold very little liquidity overall. Something like 60% do not have enough to cover a 3-month buffer of expenses. And so at least from a neoclassical theoretical context, we can think about households using credit as a way to smooth shocks over time. If you experience a large emergency liquidity need, and then credit markets could help you by providing that liquidity today, and you repay slowly over time. But more recent evidence, I think, points toward, at least empirically, that adjusting commitments, taking on a bunch of new debt may be a challenging process for many households. So what we're going to do in this paper is look at households that experience a large shock, losses from a natural disaster, and the extent to which emergency credit is helping them in terms of looking at their credit reports, their financial distress, their borrowing in the future, and so on, as a way to try to understand whether the extent to which this emergency credit provision is affecting them over the longer term. So to try to ground this a little more, we had these two really devastating events in the US this fall, two hurricanes, Helene and Milton. And especially Helene was a challenging event because it started off in Florida, but went into northern Georgia and North Carolina, in areas where sort of conventional wisdom is you are not that very exposed to hurricane-related damages and flooding. And so a large share of the losses from the floods that Hurricane Helene created were uninsured. So I think this is sort of the specific type of setting that we have in mind. Imagine one of these houses is yours. You didn't buy flood insurance, or you bought a little flood insurance, but not enough to cover these losses. How would you fund repairs to your home? Many people sort of don't have the finances in place to take on, let's say, $100,000 of home repairs, overnight. So what are we going to do in this paper? We're looking at emergency credit that's provided in this setting, and in general, understanding the effects of credit provision is challenging because private sector lenders are not providing credit in some exogenous way. It's endogenous to the households they're providing it to. So lenders are seeking to mitigate risk through the underwriting process. We might think about households who apply for credit as different from those who don't. And so there are a number of challenges in terms of trying to understand the effects of credit. And we think that our setting is one that helps isolate some of those effects. So we're going to be looking at a set of households who experience a natural disaster, who apply for a loan, and then we're going to leverage program rules for exogenous variation to compare households who received a loan because of an arbitrary threshold in the data versus ones who were just sort of on the wrong side of the threshold to create more comparable treatment and control groups in this setting. We are studying the U.S. Federal Disaster Loan Program. This is one of the primary sources of direct federal assistance to households. Many people don't know about this program, but it is the main form of direct relief offered to middle and higher income households in the U.S. So if you experience a natural disaster in the U.S. and you aren't fully insured for that disaster, the government will encourage you to apply for one of these loans. They can be used to repair homes and are almost exclusively used for that. Something like 90% of the funds is used to repair homes, but it can also be used to replace a damaged vehicle. These are low interest loans. I'll get into that a little bit more. And so we're wanting to try to understand is if people experience one of these disasters, they lose some of their most important durable consumption goods like their homes. Do these loans by addressing liquidity needs help prevent a larger set of complications that the disaster might create if you didn't have the liquidity? So we have this low interest loan application level data from the Federal Disaster Loan Program, and we're going to merge it with business credit reports. So we can do this at the individual loan level. We were able to connect individual applicants to this program with those applicants' credit reports, and we can observe applicants from several months, so a couple of years before the disaster to about 3 years after the disaster. So we can follow households over time. The program relies on some specific targets in the underwriting process, and one of those is the applicant's existing debt service to income ratio. So how much of the applicant's current income when applying is already committed to servicing debt, mortgage, car payments, things like that. And so specifically the program uses a threshold of 40. They would like for applicants to have a DTI below 40, less than 40% of their income is being used to service debts already. And they use that in this loan approval process. It's a soft rule, so there are people that receive a loan that have a higher DTI, but this is an important cutoff in the program. So we're going to use that as a threshold discontinuity design. And we have a number of disasters and applicants in each of those disasters that are approved and declined. And so we're able to have these sort of isolated experiments, disaster by disaster, that we can combine to see the effects of these loans across a variety of events over time and across geography. Here's a preview of the results. So first, we look at the credit reports information on financial distress, things like bankruptcies, loans and collections, and delinquencies. And we find that these disaster recovery loans have meaningful effects on these negative outcomes, on these distress outcomes in the years after the event. So applicants who receive one of these loans in this threshold design, they're 61% less likely to file for bankruptcy over the 3 years after the event. Similar to large declines in terms of collections. And we can follow these effects sort of through the debt spiral, the adverse distress outcomes that households might experience from delinquencies 30 days late, 30 to 60 days late, 60 to 90, and so on. And you can see these loans having effects, useful reductions in delinquency sort of throughout that spiral. We also examine other information on consumers' credit reports that may signal financial health. So one is durable spending after the disaster. We see that a couple years after the disaster, households are about 5 percentage points. Households who receive one of these loans are about 5 percentage points more likely to take out a new auto loan. This is a couple years later, so after the disaster. So there is some spending on cars immediately after the event, which is probably due to cars being damaged in that event. But a couple years later, we think this is a sign that households are replacing an aged vehicle, when it's time to do so. And the households that have received these disaster loans and have actually taken on more debt because of those loans are more likely to have these new auto purchases in the years ahead. So, we think this is a sign that they can sustain this additional debt of taking on a new car, and that private lenders are willing to, to extend them that new loan as well. So we see those as signs of financial health. More broadly, I'll show you some results regarding debt balances in terms of total debt balances, and then for mortgages, autos, cards, and so on. And we see sort of across the board that applicants who are approved for these loans tend to have larger private debt balances a couple years after the event. And so again, see this as a sign of this emergency credit helping households recover and being in a better financial position down the road. If we have time, I'll get into some of the mechanisms that we think are happening here. So these loans are bundling both, they're low interest, there's a subsidy, kind of a small subsidy built into these loans, but also they're providing this emergency liquidity. So a large amount of money that households might have trouble accessing otherwise. Lots of people don't have $100,000 that they can draw on, even from retirement savings. And so the program has a different discontinuity related to the interest rate, which creates variation in sort of the size of the subsidy. And we see that whether the interest rate is sort of set lower or higher, the treatment effects look similar. And so we're sort of taking that as evidence that it seems unlikely that the subsidy is really driving this result, and pointing more toward the emergency liquidity. The provision of a large amount of liquidity may be what's the key driver in this setting. So in terms of the broad implications, we're thinking about this as the additional exacerbating effects of unmet liquidity needs can create for negative shocks. As a reminder, everybody in our sample has experienced a natural disaster. And so we're looking at people who can have those unmet liquidity needs addressed through a loan versus people that can't. And what we're showing is that liquidity piece can add a substantial amount of distress. If you're unable to find the funds to repair your home, for example, you're more likely to end up in bankruptcy and have a lot of other negative consequences in the years ahead that delay recovery from the disaster. We've benefited a lot from a couple of literatures here on the causal effects of credit, on liquidity and financial distress. There's been a lot of great work recently on that. This series, among a number of other publications too, we've benefited from those in terms of trying to understand climate risk. And I've been remiss in including a lot of great references here in terms of including those in this series. So let me not belabor the lit, but we benefited a lot from sort of very active space. Okay, let me tell you a little more about this disaster loan program. This is a program that's been around for over 50 years, and it provides loans directly to households who have experienced uninsured losses from a natural disaster. So some households don't have any insurance for the damages that they experienced. They might have experienced a flood and not had flood insurance, for example, or they might have damages that exceed the coverage that they have for insurance. So, with flood is another great example where the National Flood Insurance Program has limits of, I think, $250,000 in terms of our time series on the amount that they will cover, and this loan could cover damages that exceed the maximum that people can purchase with flood insurance. There's a lot of other types of events in the data, but floods and hurricanes tend to be the largest one. I think they affect more people than any other type of disaster. And because flood insurance has to be purchased separately, people are much less likely to have flood insurance than homeowners insurance. The median loan is $25,000. It has a low interest rate. The average in our data set is 2.5% and has a duration of 20 years. And this sample that we have, I sort of mentioned this earlier, typically excludes very low income households. So what happens is when a disaster happens in your community and there's a federal declaration, FEMA sets up a tent. And if you are a household near the poverty line, the FEMA will encourage you to go directly to the grant program And households who have incomes above 125% of the poverty line are encouraged first to apply for one of these disaster loans. So we don't tend to have very low income households in this setting. Here's a map of the applicants in our data set. So our data is going to start in '05 and include important events from that year, like Hurricane Katrina, and it will end, well, the analysis that I show you will end in 2013. The events we include go through 2013. We have a little more data on the after that through 2018 that I'm showing here, but in terms of the credit reports that we purchased, I'll say a little bit more about that in a minute. We ended the analysis a little bit earlier to make sure we had enough time to examine outcomes afterward. Here's where applicants are in our data set. So these are zip codes, and you can see they come from across the US. They certain zip codes, especially sort of in the Gulf states and the Southeast, tend to be overrepresented here relative to population. But every state in the country has an applicant in our time series, except for Idaho. So if you're thinking about, where would you want to live to avoid climate risks, at least in the recent historic past, Idaho's looking pretty good. So we had this federal disaster loan application data, and it has a lot of rich details that are used in underwriting, like the applicant's income, their existing debt payments, their credit score, information about the disaster damages itself. They provide an on-site, the SBA runs the Federal Disaster Loan Program. So I will try to refer to it as the Federal Disaster Loan Program because the U.S. Small Business Administration manages this program, but none of the households here are connected to small businesses. It's just that the government decided 50 years ago that the SBA should run this lending program. So I'll try to make sure to call it the Federal Disaster Loan Program, but we'll mess up on that. Occasionally, all the loans that we're examining are to households. So we had this detailed information on the underwrite that's used in the underwriting process in terms of the applicant's income, and the program engages in an on-site loss inspection too, so we understand information about the size of damages as well from that process. And we're going to take this application data and merge it with census data using Social Security numbers. And I'm sorry, not with census data, this with Experian Credit Bureau data, and merge it with Social Security numbers. And we're able to observe the kinds of things you observe on a credit report. So there's information from Experian in terms of bankruptcies and delinquencies, like I mentioned earlier. We can also observe balances, and we can observe these outcomes in the aggregate, and then also separate them for certain types of loans like mortgages and credit cards and auto loans and so on. Our Experian data began in 2003 and end in 2015. And so what we'll do is we'll create a balanced panel where we look at an applicant. We can follow an applicant from 1.5 years before they experience a natural disaster until 3 years after a natural disaster. And so, we're sort of bound by that time of the credit reports. And so we're looking at disasters that are occurring between 2005 and 2012 in terms of this analysis, so we can create these balanced panels. Here's some summary statistics showing applicants and borrowers. There's a larger set of these in the paper, and I won't belabor this. Overall, in general, household income looks around the national level of household income in our time series. A little bit higher because these are mostly homeowners that are applying for these loans. Note in particular the loss amounts. So the average loss amount is $86,000. The median is around $47,000 for these households. This is over a year's worth of income. So we're thinking about this as a big shock on average to households. And the median household has insurance, but is only receiving a claims payment of a little below $5,000. That's skewed, and the mean is at $37,000. So many of the households in this setting may be receiving something from insurance. Maybe they experienced a hurricane and experienced some damage that the insurance covers from from wind or from other complications of the hurricane, but then may have also had a lot of flood damage from that same event that's not insured. And so I think, the many of the households here are sort of partially insured from the events that we're examining. So the high level summary of our identification and estimation strategy here is that we're going to leverage the program's DTI rule in underwriting that I was talking about earlier, where they have a target that approved applicants have a DTI below 40. We're going to use that threshold to randomize treatment, and then we are going to take that treatment randomization and pass it to a diff and diff, event study style diff and diff, where we can follow these applicants over time. So in that case, the threshold acts as an instrument in the diff and diff, and we can see these approved and declined applicants beforehand and follow them afterward in this regression discontinuity style design, where we were accounting for the
Sorry, Ben.
dynamics. Hey, Richard.
Hi, can you remind us what DTI stands for?
Oh, sure. Sorry. DTI is debt service to income, sometimes just called debt to income. This is the share of your monthly budget that goes towards servicing debt. And in this program, they rely on this 40% target, where if more than 40% of your income is already going to service debt when you apply for one of these disaster loans, they're notably more likely to reject your application. So here's the loan approval, RD plot here, where you can see just above 40, around 60% of applicants are approved. Still pretty high approval, I guess, overall. But just below 40, there's a 20 percentage point higher approval rate at around 80%. So this DTI threshold is an important one. And I think the motivation here from the lender is the disaster loan program is they want to make sure people are in a position to repay these loans. And if they already have very high debt loads, they may not be able to take on that additional debt given their monthly budgets. This is we see this in the data, this threshold. It's also written in the loan officer's manual that they should be targeting this, have this target of below 40.
I'm interested that it's kind of under 90% for even quite significantly lower debt to income. So do you have a sense on what else they're kind of thinking about or screening on?
Yeah, great. So they also rely on the applicant's credit score, and then there is some discretion offered to loan officers. The program thinks of itself as sort of the lender of last resort, and on a needs base, they make additional adjustments through loan officer discretion. So there's two other criteria. We looked at the credit score as well. The program has adjusted its credit score rules over time. And in general, I think you should think about the effects of credit score on loan approval as monotonically increasing. Higher credit scores are more likely to be approved, and mostly smooth. And they, at different points, they've had different targets. So if you narrow in on a specific period, you can actually also see some jumps around credit scores, but they tend to be smaller in the period that we're studying. The key threshold, discrete threshold that they're relying on is this DTI one that seems like a pretty important one to them in this process. Is that answering?
Yeah, that's great. Thank you. There is a question in the chat about whether households can manipulate the running variable in order to keep themselves kind of below the threshold.
Great. So this, as I'm noting here, this threshold is written in the manual. And that manual is publicly available. So it is theoretically possible that people would find this information beforehand. So let me note that they generate this DTI by looking at your IRS tax returns from last year. So that's the I, the income. And the D is the debt service amounts from the credit report. So these are two sort of independently provided numbers from IRS and from Experian and the other credit bureaus. So these are a little more difficult to manipulate. Consumers may not applicants may not even know the precise numbers, that end up getting compiled on the credit report. They're probably very close to what they, are paying out of pocket. So they can't manipulate it in the reporting process. There is some possibility, I guess, that they're trying to adjust their debt levels in real time. We do look at the smoothness of DTI, and you can see that there's a larger share of folks with DTIs that are sort of in this 20 to 30, 35 range, drops off pretty quickly. In looking at sort of smoothness sorting test kind of estimations, we're not finding any sort of significant jump right around this threshold that reduces, I think helps reduce concerns that we're seeing a active manipulation here. And then the other thing sort of related to discontinuity is we're looking at the covariate balance around this 40 threshold. So, are other things continuous or other things smooth through this threshold? And it seems like they are based on the observables that we have. So I'll come to like an assumption slide in a little bit, but I think the question is a great one in terms of manipulation or other in continuity are sort of important here in thinking about the assumptions, and at least in what we can observe that we seem to be sort of meeting the core standards there.
Quick question. Do you have any information on repayment? I'm just curious, given your earlier discontinuity. Is that something you look at all or
I am not going to talk about I'm not going to show you results related to repayment today. We do see if these loans move into default, if the borrower has not been servicing this loan for, I believe it's 120 days. It's either 90 or 120 days. It follows sort of federal standards. Then the loan gets sent to the Treasury offset program, which is a collections program where Treasury attempts to, they consider the loan in default and Treasury pursues some collections, and it's recorded as charged off federal debt to the credit bureaus. So in that, something like 12% of these loans end up ultimately going into charge-offs.
and I assume I was just curious whether that's related to DTI.
I see. Great question. Yeah. So
the figure just before this one.
Yeah, this one.
No, I was thinking the discontinuity.
Yeah, this one here. Yeah.
So
yeah.
this
We
one,
take a big
yes.
jump in yeah, great question, Glenn.
So loan repayment by DTI, I guess. I mean, this is something the SBA should be interested in, but
Sure.
maybe it's off topic on a bit on
No,
this.
I think that's great, and that's something it's something we should definitely look into. I think we've got data on this, and we can, and it would, it would I guess be important in terms of interpreting the results if there was a big discontinuous change at this threshold and things like default. So in terms of the estimations, we are going to use the threshold as an instrument for approval. And then we're going to use that instrument as treatment here. So we're looking at whether being approved for one of these loans affects outcomes like bankruptcy, and we're instrumenting for approval using the DTI threshold. We are using an event study design where we can see applicants before and after the event, and we leverage more information especially on things like balances in terms of using a diff and diff where we have fixed effects in these models. And so we're going to generate sort of clean controls in this setting by allowing for fixed effects to be estimated by disaster. So zip by disaster, fixed effects, and time by disaster, fixed effects. And so this helps deal with the concerns about sort of a staggered treatment here, where we have a bunch of discrete disasters that each get their own set of fixed effects. And then we're sort of going to add these together. They're all going to be in the same regression, which will give us a sort of an average from the combination. So I'm not trying to be too vague here, but also worried about getting too bogged down in the slide. If you have questions about this, I'm happy to answer them. So in this approach, we're combining like a fuzzy RD. So this is an instrument because a fuzzy RD is always an instrument with a diff and diff approach and need to meet the assumptions of these models. I think that we do in terms of this is an important threshold at 40. It's not obvious, at least from what we can observe, that other things are changing at 40, which helps with this sort of exclusion restriction needed for an instrument. Because we see in the data and in the loan officer manual that having a DTI below 40 at least weakly improves approval. And so this aligns with sort of this monotonicity assumption needed for a late interpretation. And if the instrument is valid, then we shouldn't have, we should have effective randomization into treatment here, but we can also examine in the event study for parallel trends as a type of a check to see, are we getting unusual pre-trends in the data that might create concerns that there's something happening that's not, not being fully randomized. Okay, let's get into some of these results. They're roughly divided into two areas, measures of financial distress, and then the second part is sort of crowding in of private markets. And, I think as a reminder, everyone in this data set has experienced a disaster and is applying for a loan. And so the kinds of treatment effects that we're going to show is how does receiving this emergency liquidity affect the likelihood that you're experiencing, that you're filing for bankruptcy and so on. So let's start with these bankruptcy effects. This is showing two things in terms of bankruptcy. One is new bankruptcy filings in the sort of green triangles. And then the red is the accumulation of those. So the likelihood of ever filing for bankruptcy by some certain point. So the green is like a flow variable and the red circles are more like a stock variable. You can see following the disaster that the recipients of these loans are less likely to file for bankruptcy. They're statistically significantly less likely to file for bankruptcy in terms of like 1 year after the event, 1.5 years, 2 years. The other coefficients in the green aren't statistically significant, but sort of they're all suggesting that the likelihood of filing is a little lower for these applicants. The cumulative effect is larger, and that's shown in red here. So if we sort of look out to the end, the difference is ends up being about 61%. I have a typo here in the note. So it's more like a 2 percentage point decline. This says 3.3. And I think that's just based on some updates that I didn't fully incorporate, which is around a 60% effect reduction. So we see notable declines in the likelihood of experiencing bankruptcy. And this is an important outcome in terms of it sticks with you on your credit report. There are lots of spillover effects of bankruptcies in terms of on lenders and others as well. So we see this as kind of a key outcome here. We're taking on more debt to repair your home and so on. In this case, actually reduces the likelihood that you file. Backing away from bankruptcies to collections, which is also a serious outcome that tends to stick with consumers on their credit reports. We're also we find meaningful effects of collections. So collections occur when your loans are severely late, over 90 or 120 days late. It sort of depends on the product. The loan officer or the lender will take a loan and they'll send it to a collections agency. They sell it to an agency and the agency tries to recoup some of the owed amount on that loan. And so this is something that also has a very negative stigma on your credit report. And we can see that receiving one of these disaster loans reduces the likelihood of then like having loans in collections by about 5 percentage points a few years after the event. So this is a notable reduction relative to the baseline prior to the disaster of around 18% of people had some sort of loan in collections prior to the event. So in both of these cases, we see these as sort of meaningful reductions. This is the amount in collections, which is going to combine sort of intensive and extensive margin effects. But I want to focus on this a little more, which is sort of the path, sort of the debt spiral into severe distress. So you can see here, starting at the bottom, these are all outcomes at 2 years after the disaster. So if you take this sort of event study design like this and you look out to this 2-year point, here we're reporting that coefficient in this table. And so this likelihood of collections is the same as any collections at the top. But you can see here, 2 years after the event, that these negative treatment effects, where disaster loans reduce the likelihood of sort of any level of delinquency in terms of 30 to 60 days late, 60 to 90, more than 90. Loans in derogatory status, which is these late loans that haven't been sent to collections yet, and then the collections as well. So sort of throughout this path toward getting behind on your debts, being unable to pay those, having, incurring additional fees and so on, these loans are reducing sort of that whole path, which seems to be an important channel in terms of households moving from sort of getting behind to being unable to dig their way out of these really severe delinquencies. So I do want to note in this setting that these effects are looking like these folks are better off who experience a disaster, and I think they are, but it's relative to a counterfactual in which they experienced a disaster, applied for a loan, and didn't get it, because that's the control group here, a group of people that experienced a disaster, wanted a loan, and didn't receive that loan. So I think the raw data is useful in this context. This is using the same bandwidth that we're using in the rest of the estimation, which is of a DTI bandwidth between 30 and 50, so 10 points below and 10 points above that DTI threshold of 40. And so the dotted line is showing people above the cutoff, so having DTIs between 40 and 50. The black line is people with cutoff, or with the DTI between 30 and 40. And so the solid line people are more likely to receive the loan. You can see that both groups look worse off after the event. There's a short dip down. There's a period after disasters where lenders often will sort of defer loans, will sort of not count delinquencies against the borrower in that period right after a disaster. So we can see a little dip there, but pretty quickly, once they start looking at delinquencies again, you see these delinquency rates going up, notably for both groups. And including the group that's more likely to receive a disaster loan, they look worse after the event than before. And I want to point this out sort of in recognition that these people look worse off despite receiving one of these loans. These loans don't totally remove the adverse effects of the event, but they stave off some of the additional outcomes, negative outcomes that people seem to experience from not being able to access emergency liquidity. This is a picture looking at the delinquencies on different types of loans 2 years after the events, after the disaster. So we have likelihood of having card delinquencies, credit cards, having a delinquency on your mortgage and your auto loan. And so these are the treatment effects in each of these categories. And we see the largest treatment effects on cards. And then in terms of the point estimates, the mortgage one is a little smaller and the auto one is the smallest. So the largest marginal effect is on card delinquencies. Our take on this is that if you think about a household who's sitting down and can't pay all their bills and trying to prioritize which ones to pay, they're most likely to pay their auto loan and then their mortgage and then last on the card. And this may reflect that auto delinquencies catch up with you fast. You come get a boot on your car, you lose that vehicle, the auto lender takes that back. Mortgage foreclosure process can take some time. The card is uncollateralized, and so those fees can rack up, but there's no collateral seizure there with the card. And so we're able to see something about the prioritization that households have in terms of which debts to repay by looking at how receipt of one of these emergency loans affects the likelihood of delinquencies in each of these categories. We also find some heterogeneity in terms of credit utilization. I'll just give you the high level of this because I want to get into some of the balances work. The high level is that people who had higher levels of utilization, so were closer to maxing out their credit cards, tend to receive more benefits from these loans. They have the reductions in delinquency, the treatment effects on delinquency are larger for those populations. Perhaps not entirely surprising, but I think it's sort of reassuring that it's pointing toward this channel that people who are already more liquidity constrained prior to the event, at least as measured by credit utilization, that those people are the ones who are more likely to have these, these are the people that have larger treatment effects following the disaster. We engage in a number of specifications to try to understand robustness, including individual rather than zip fixed effects, different controls, sort of a donut specification. Katrina is a really big event in the data. And so we also look to see if the effects exist outside of Katrina. Here's the general results for bankruptcy. We have the other ones in the paper, but I didn't include them all here. In general, we're finding these sort of meaningful and lasting effects across a variety of specifications. Okay, I want to talk a little bit about crowd-in. I think this is one of the pretty interesting set of results here. Our priors in coming to this, I think, may align with some of yours, that if people are rejected for a federal disaster loan, the most direct substitute might be a loan from a private institution. So maybe I apply for refinancing on my home if I have some equity that I could extract there, a home equity line or something like that. So we might expect some substitution there between disaster loans and then private loans. And there have been concerns raised about this program that by providing low interest loans, the government is effectively crowding out the market, which sort of aligns with that idea that there may be substitution between these products. So what we actually see is something that looks more like complements instead of substitutes, where the individuals who receive these loans tend to have larger debt balances, as I mentioned earlier. So here's this first result on new auto debt, sort of new durable spending following the event. And you can see that there is a larger spike around 6 months after the disaster in this figure. But there's also this sustained effect that 2.5, 3 years after the event, individuals who receive one of these disaster loans are about 3 or 4 percentage points more likely to take out a new auto loan. So they're which we interpret, like I said before, sort of it's time to replace a vehicle, and these individuals are able to apparently go out and garner that loan financing from a private lender to replace a vehicle.
Good clarifying question. You mentioned that these SBA loans aren't reported on the credit report.
Yeah.
So do you think this affected kind of individuals, like kind of self-regulating? So like the lender kind of can't see this, this kind of anything on the credit status. So is it kind of individuals like self-regulating their kind of payment burden?
So they might look more, I think part of the comment or question, Fran, is that like if you have debt that's not showing up on the credit report, you look more attractive to lenders. So one mechanism that might lead to like more auto loans is that you're more likely to qualify if your credit report looks better. Is that fair? Yeah, I think that's a fair, that's a fair comment that agree with. So these loans only end up showing up on your credit report if they're in default, basically, if they're reported, by Treasury is charged off federal debt. So these are loans that there may be differences in access between the approved and the denied folks because of differences on their credit reports. But given the results in terms of distress as well, I think part of the story that's happening here is that individuals who are denied a disaster loan appear to have notably more financial distress, and is also likely contributing to how they're being viewed by lenders. They're more likely to file for bankruptcy or have delinquencies on their reports. And I think it's pointing toward a larger sort of underlying differences in financial health too of these households who are able to receive a loan and repair their property. Here's a broader table, and like I was showing you before with the debt spiral, here's a set of different outcomes that we can run and these are all run based on the event study style design. I'm just economizing on space here, so you can see that 2 years after the disaster, borrowers tend to have larger debt balances overall, including in terms of their mortgage. I think part of this is and then these auto loans, part of this is taking on new debts like the new auto loan, and then part of this is that by helping households continue to engage in these repairs, these households are more likely to continue servicing existing debt. So this reflects a combination of households servicing debt they already had before the disaster, and then in some cases taking on new debt. And so you see, yeah.
So this would tend to if these households that were denied kind of had access to this some kind of private lending, right, you would presumably see the opposite here, right? That you're like, if these really act as substitutes, then like there's a bunch of households that were denied that if they could access this, at least in the like small bandwidth you're looking at, they should be having kind of higher debt burdens because they have the similar types of expenses.
Yes, great. Thanks, Fran. So like, exactly. So if I'm rejected for a disaster loan and my best alternative is to go out and refinance my mortgage, then disaster loans should result in like smaller mortgage balances. The effect should be going in the other direction, which is like a substitution kind of story. And that's one of the most surprising results for us, we think, sort of in looking at this, is that giving these households debt to repair their homes leads them to have more debt in the future, more private debt as well, instead of it being a substitution for that private debt. We're not entirely sure why that happens. One possibility here is that the kinds of loans that are the largest loans that people take tend to require collateral, like your mortgage and your auto loan. And so if your home's damaged and you need to repair that damage, the lender may be very cautious about providing a loan to you using a damaged home as the collateral there. So we don't know exactly how that works yet in the private market, but for some reason, households who are rejected from these loans are not going out and getting loans, refinancing their mortgage or taking out HELOCs. This is showing a couple of other outcomes where we expected to see notable effects and we aren't. So one is the likelihood that you've moved within the last 6 months. We've done this a couple of ways. So on your credit report, we observe your zip code, and this is showing the likelihood that you've moved since the treatment effect on the likelihood that you've moved since the last credit report, so 6 months ago. We've also done it looking at the likelihood of moving relative to before the disaster. We don't find any effects here. Receiving one of these loans apparently does not affect the likelihood that you continue to live in that same zip code. It also has almost a null effect, with confidence intervals overlapping 0 on whether you have a mortgage after the event. So there's a point estimate that's on the positive side, but too large confidence intervals to interpret that. This moving thing is something that was surprising to us, given prior work by Tatiana Derugina and others, like sort of showing that people are more likely to move after an event. And so, and we did some additional analysis with our data, looking at sort of a national sample of credit reports, and we see that people in these disaster areas are more likely to move. It's just that the approved versus denied differences here aren't significant. So one potential sort of speculation there is that people may be moving for reasons other than this loan. If they find a new job opportunity elsewhere, they may take this as a time to move. It doesn't seem like this loan is what's determining whether they stay or whether they go. There's a section here on this, is this a loan subsidy where the loan subsidy is pretty small? Well, I guess I'll leave that to you, whether that's small. Like OMB is estimating the subsidies on these loans are around $6,300, which results in around a $40 a month subsidy. And we leverage variation in the interest rate to try to understand if you change that subsidy notably, does it matter in terms of some of these results? And it doesn't appear to. I will skip that in the interest of time because we're at 50 minutes, but happy to talk more about that, in the Q&A afterward. So to sort of summarize here in my last minute, we're looking at this setting as one where we can try to understand the climate effects, but in a broader sense, understand the financial frictions that are leading households into distress. And noting that there's a lot of folks that just don't have much liquidity, and credit markets might be a way for them to navigate emergency needs. But we're finding that notable frictions in terms of households' ability to access liquidity in the private market following these disasters, which creates some important effects from the government providing these low interest recovery loans. Okay, thank you for your interest.